All right, welcome. Today, we are going to decode one of the most fundamental ideas in all of trading, that constant battle that's happening on every single price chart. Yep, we're talking about the push and pull of support and resistance. Let's get right into it. When you first look at a stock chart, it can feel, well, pretty chaotic, right? It's just a bunch of zigzagging lines. But what if I told you this isn't random noise at all? This is a language. It's telling a story of a constant tug of war in the market. So the real question is, how do we learn to read it? The key is to stop seeing those random squiggles and start seeing the structure underneath. Think of these charts as a battlefield for two opposing armies. You've got the buyers who are trying to push prices up, and you've got the sellers pushing them right back down. And this constant struggle creates these invisible floors and ceilings that the price actually respects. In this section, we're going to learn exactly what those are. So first up, let's talk about support. Just think of it like a price floor. It's a level where buyers suddenly get a lot more interested, a lot more aggressive, and they create this surplus of demand. So when the price falls down to this level, enough buyers step in and basically say, nope, not going any lower, and the price tends to bounce right back up from there. And on the flip side, of course, we have resistance. This is the ceiling. It's a price level where sellers get really motivated either to take their profits or maybe to start a short position. This creates a surplus of supply. So as the price gets close to the ceiling, the selling pressure gets strong enough to stop the rise in its tracks and push the price back down. So let's just make it super clear. Support is buying pressure that creates a floor. Resistance is selling pressure that creates a ceiling. They're really just two sides of the same coin. But what's so fascinating is that these aren't physical barriers. They are psychological ones created by the collective mindset of literally everyone in the market. Okay, so we get the what, but how do we actually find these levels on a chart? Well, it's not magic. It's more like being a detective. We're going to learn how to connect the dots the market gives us by looking for those historical clues where the price has turned around before. But here's where it can get really tricky, especially for new traders. You draw this perfect neat line, and then all of a sudden, the price just pokes right through it for a second, what traders call a wick on a candlestick chart, before snapping right back. So, was the level broken? Did you draw it wrong? This is the super frustrating problem of false breakouts. And this brings us to probably the single most important mindset shift you can make. Support and resistance are not laser precise lines. You have to think of them as zones or areas of interest. This is where the balance of power is just likely to shift. Thinking in zones instead of exact numbers is really the key to not getting shaken out by all those minor noisy fluctuations. So how do we find these zones in the real world? Well, you're looking for areas with multiple peaks or valleys, just like you see here. The more times a level gets tested and holds, the stronger it is considered to be. But here's a fantastic pro tip for you. Switch your chart over to a line chart. A line chart filters out all that noisy day-to-day volatility, all those knee-jerk reactions, because it only shows closing prices. Just look at how much cleaner the picture becomes. It makes the real zones of support and resistance just pop right out at you. And, these floors and ceilings don't always have to be perfectly horizontal. When a market is trending up or down, support and resistance actually become dynamic, and we call these trend lines. In an uptrend, a line that connects the higher lows acts like a rising support level. And in a downtrend, a line connecting the lower highs acts as a falling resistance level. Okay, so identifying a zone is one thing, but how do we know if a move has any real strength behind it? How do we gauge the conviction of the buyers or the sellers? For that, we need to add one more crucial piece to our puzzle. We've got to start looking at volume. Now, this isn't some new idea. It's actually a core principle of Dow theory, one of the original pillars of technical analysis. The theory states that volume must confirm the trend. And why is that? Well, because volume measures participation. It tells you how many people are actually behind a move. High volume signals high conviction, low volume signals uncertainty. Simple as that. Let's make this really, really practical. Take a look at this cheat sheet. If you see the price break out of a zone on really high volume, like you see in that first row, that signals a strong move. There's real conviction there. But if you see that same exact breakout happen on low volume, like in the second row, you should probably be skeptical. That could be a trap. The simple relationship between price and volume is your key to confirming whether a move is the real deal or not. So, now let's put it all together. We know how to identify zones, and we can use volume to check for conviction. So how does this actually translate into a strategy? Well, broadly speaking, there are two main ways traders use these levels. You can either trade the bounce or you can trade the break. The bounce strategy is pretty straightforward. It's based on the idea that these zones are going to hold firm. You identify a strong, well-tested support zone, and you look to buy as the price comes down to it and shows signs of turning back up. And similarly, you look to sell when the price hits a strong resistance zone and gets rejected. You're basically betting on the floor and ceiling doing their job. Now, the break strategy is the complete opposite. You're betting that the floor or the ceiling is finally going to collapse. So here, you wait for the price to move decisively through a support or resistant zone. And what's our confirmation signal? You got it, high volume. A high volume breakout signals that a really significant shift has just happened and that the price is likely to keep going in that new direction. And before we wrap this up, two final really crucial points. First, these levels can actually change roles. When a strong resistance ceiling is broken, it very often becomes a new support floor. Think of it like this: old ceiling, new floor. And second, the longer a level holds, the more energy is built up behind it. So when a level that has been tested time and time again finally breaks, the move that follows is often super powerful and explosive, which leaves us with one final kind of fascinating question to chew on. Are these zones a kind of market physics, a natural force of supply and demand, or are they just a giant self-fulfilling prophecy working simply because millions of traders are all looking at the exact same charts at the exact same levels and acting accordingly? It's a powerful thought about market psychology and something to keep in mind as you start seeing these floors and ceilings everywhere. Thanks for tuning in.